Yeah. So for those of you who don't know Matt, you might have seen some of his stuff if you follow him on social, especially. He really is the industry whiz when it comes. He has this unparalleled ability to really focus in on the penalty rates and all the details that come along with it, and really dissect it and break it down and explain it in a way that is really understandable and digestible. So I wanted to have him on to go over this, and I know that you've been really focusing on it these days. So you originally started in the industry, I think 2015.
Yeah, so 2015, so it's been just over 9 years. It's crazy that time flies,
I
it's
know. I can't believe it's been that long. So you were with Mortgage Alliance originally, then
I was
I
with Mortgage Alliance for about, I guess, 5 years, and then came over. I was with mortgages.ca, more of an Ontario team, and then I joined Team Borley. I'm sure everybody knows Tara and her team. And but over the past, a year and a bit, I've been just focusing more on penalties. Like it's my passion. Like I look at it, it's really the elephant in the room, and I don't see myself as the king. The lenders are the kings. They're the ones with the gold. They're the ones with, I'm the jester. I'm just hoping not to lose my head. And maybe while I'm doing this, while I'm entertaining all of you, that you're saving your clients some gold and you're making some gold for yourself. So that's where it just comes down to it, that the lenders make the rules, but do we really understand the rules? And not
absolutely.
understanding these rules is going to either lose an opportunity, miss an opportunity, or put the clients in danger while the lenders are making all their gold, right? So just things we have to pay attention to. And we're going to really go through, and I'm going to make it as simple as possible. I put out a lot of stuff. If you want to learn more, you can definitely reach out. But I just want to make it really simple, because the easier it is for us to understand, the easier it is for us to explain it to our clients. And penalties are complicated by design, because if you don't know where you're at, you don't really go anywhere. And not going anywhere makes the lenders a lot of money.
Yeah, 100%. Especially now, I think that there has never been a better time to really focus on this topic with, rates going back down. People are wondering, is it worth my time to early renew? And it gets a little complicated. So it is really nice to have an expert like you come and simplify it for us. We tend to forget that, we do use a certain type of lingo in this industry that maybe our clients might not understand because we're so used to using it on the daily. So yeah, we're really excited to have you on here today. And I'm just going to turn it over to you.
Perfect, perfect. So we're going to go through a couple slides, go through a couple scenarios, and then really just want to have it with people have questions. Like I love having it. You ask questions. You're on the front lines. You're seeing all these mortgages. Just how can I help you to win business? It's competitive out there, but there might be some secret powers or features with certain mortgages we're not really paying attention to. So with mortgages, and we're going to mostly talk about fixed rate closed term mortgages, you have to imagine them like car insurance. Okay. And so if you think of car insurance as someone's advertising the lowest car insurance premiums, anyone can save you money on car insurance if you're willing to increase your deductible. And that's how we have to kind of look at these mortgages, right? There are mortgages where the rates are really, really low. You're not paying as big of a premium, or you're foregoing the premium, but your deductible is massive. And the thing here is the lender won't tell you what it is unless you ask, and it's changing every day. If you checked your car insurance paperwork and you saw that they changed your deductible from 500 to 3,000 and didn't tell you, you had to call in, you'd be pretty upset. And as brokers, we need to know when the deductibles are really high, so the clients are aware of the risk, or they're really low. Maybe it just comes down to something happens. They don't, they crash their mortgage before they reach their destination, the end of their term. Well, maybe we can find some value and save them some money. So I'm going to share my screen here. We're going to go through this. So yes, and I'll share a portion of screen. Now I just got to adjust this up here. So there and there. Okay, let's pull this up here. So we got to look at it. Penalty traffic lights determine if you should keep or return the mortgage. Okay, red, it's more than expected. So like a big interest rate differential, you tend to keep the mortgage. If you're selling the property you want to port, you need to be really adding a ton of value, or have it where you have to return that mortgage. You're selling a property, not buying. Most likely, if the mortgage is in the red, you're keeping the mortgage. If it's yellow, it's what's expected. The lender is charging you, an interest rate differential, but it's what it should be. Rates have come down. They're comparing your high rate to a low rate. You really only return that mortgage if, let's say, you're consolidating some of their debt. Maybe you don't port because you want to deal with a new lender versus the incumbent lender. At the end of the day, if it's what's expected, it's more yellow, you have to find some other way to add value. If it's less than expected, in that case, you want to replace it. Now, you'd want to make sure that they're keeping the new mortgage long enough for it to make sense. But really, when we look at all our mortgages and we look at the deductibles when it comes to these penalties, it's either red light, yellow light, green light, and they can shift between them based on their rules. So an example of a mortgage that's more than expected. If you have a client who got a Scotia 5-year, 4-year fix, and it closed August 8th, 2024, I'm sorry to tell you, but your penalty, your IRD, is more than it should be. Okay? If you have monoline mortgages, they tend to be what it should be. And for green, less than expected, our TD Bank 5-year, 4-year fix from exactly 1 year ago today. The penalties, the deductibles are much lower than they should be. And so we're going to go through a Scotia example. We're going to go through a TD example so that you can see what's happening in the, in the back in order to trigger these penalties that are more than they should be or less than they should be. So we have it here with Scotiabank. So if someone got a 5-year or 4-year fix, so if they got a 5-year fix, Scotia sets the discount based on the posted rate at closing. So up until August 9th, the 5-year posted was 6.79%. The 4-year posted was 6.74%. They've had the mortgage for just under 4 months. We're still comparing the 5-year to the 5-year and the 4-year to the 4-year. So we'll just do some quick math over here. If a client, let's say they got a 5-year fix at, I don't know, let's just say they got a really great rate, a 4% rate. In this case here, the story that Scotia would be saying is we lent you the money at 4%. We take our 6.74 minus 6.49, 0.3%. We take our 4% minus 0.3. They're telling you that they can only earn 3.7%, even though bonds are higher now than they were in August. So in this case here, that mortgage, you progress, let's say 4 months, right? We have an interest rate difference of 0.3%, 0.3% times 4.667 years, or 0.667 times 0.3. We're estimating an IRD of 1.4% of whatever our balance is, okay? To get an idea of what 3 months interest would be at that same percentage, we take this, we multiply it by 4, and that would mean we'd need to have a rate closer to 5.6% for the IRD in 3 months interest to be the same. But with a rate of 4%, we know that 3 months interest, we divide it by 12, we multiply it by 3, we know 3 months interest is closer to 1%. So in this case here, we're seeing an interest rate differential greater than 3 months interest because Scotia is saying we'll lend you the money at 4%, we can get 3.7. If we then go and look at our 4-year, so we still progress that same 4 months, let's just say we got the same rate, 4-year, 4% fixed. In this case here, 6.74 minus 6.34, 0.4%. The story that they're saying is we lent you the money at 4%, we can get, 4% minus 0.4, 3.6% on a 4-year. I'm pretty sure none of you are getting a 4-year fix at 3.6%. So in this case here, we take that 0.4%, we multiply it by 3.667 years, and we have an estimated interest rate differential of over 1.4%. So both of these mortgages here have interest rate differentials in which we'd want to make sure the clients are aware. Let's just check the questions here. There's lots in the chat. Okay. Is it sharing my screen? I'm sharing my screen, right?
Yeah,
Yeah,
you can
okay.
see it.
We can see, okay. You might need to change your view in the top right corner is my...
Yeah, I think some people are just having...
okay, I see, okay. So
not you, Matt, you're good.
Okay. So I'll make this a little smaller. Okay, so that's what we have for the Scotia example. Are there any questions about the Scotia example? Okay, we'll keep going. So now we're looking at TD Bank, okay? So in this case here with TD Bank, it's a little bit different. So if someone got a 5-year fix exactly 1 year ago today, okay, we're working off 7.04. We have 4 years left. We're comparing it to 6.74. So in that case there, and let's just say, I mean, we saw some pretty high rates. Let's say the rate was 6%, okay? So someone has a 6% 5-year fix with 4 years left. The story that TD is saying is we lent you the money at 6%, we can get, we'll take this to determine the interest rate difference of 0.3%, 6% minus 0.3. The story that they're telling is that they can earn 5.7%. I don't know if you've seen a TD rate sheet recently, but I'm pretty sure the 4-year fixed rates aren't, 5.7%. So in this example here, the interest rate differential is less than it should be, and it's actually less than 3 months interest, so the penalty is 3 months interest. This is a green, you need to look into this opportunity. The Scotia ones there are just ones you want to tell the client. Now, we'll just go through one more thing here quickly. And so why it's so important with banks that use posted rate and discounts that we don't just go and disqualify a client by thinking their penalty is more than it should be, or we don't assume that their penalty is less than it should be. We need to know where we're at. So we'll go and look at our example. We'll go one more slide here, okay? And so you look at it. If someone got a 5-year fix from August 8th, 2023, we know that their rate was higher than 4%. Let's say that their rate was 5%. So they have a 5% rate. They've had it for a year and 4 months. So they have 3 years, 3.667 years remaining. But their posted rate when they got the mortgage was 6.54. So if we look at this mortgage here, and we take our 6.54, now we're being compared to the 4-year. We subtract 6.34. We have an interest rate difference of 0.2%. And from there, if we take our 5% rate minus 0.2, that 5% rate from August 8th, 2023, Scotia is saying we can earn 4.8%. The Scotia mortgage that the 4% that closed August 8th, 2024, they're saying 3.6%. So on something that's a higher rate, we're expecting a bigger penalty, but it's actually smaller. On something with a lower rate, we're expecting a smaller penalty, but it's bigger. That's why it's important that we know where we're at so that we can provide the appropriate advice to our clients. Let's just check the chat here. Okay, so perfect, good. So that's the presentation there. If there's any questions, any scenarios anyone wants to go through, we can talk about the trends. There are so many trends that we're seeing right now. And really what it's coming down to is this, okay? And it's why the monolines, maybe they aren't doing as good of a job of explaining the value of a monoline, okay? So let's look at 2 insurance policies, monoline insurance policy and bank insurance policy, okay? The monoline one has a much lower deductible. It's the policy with the $200, the $300 deductible. The bank one is the one with the $2,000, $5,000, $10,000 deductible, but they're not really telling you that that's the case. Because what we're seeing when it comes to posted rates is posted rates are much higher than they should be. Even if bonds go up slightly or stay flat, we're expecting posted rates to continue to drop. Posted rates are the IRD lever. For the monolines, if rates stay flat, it's virtually guaranteed your penalty is 3 months interest. And if bonds go up, they have to raise their rates, which causes interest rate differentials to drop. So that's where we look at these products, why the rates are diverging so much is because the deductibles are diverging. And that's why it's very important. We can't think we're super smart or our clients are super smart. If they take a bank 3-year, 4-year, 5-year fix and return it within the next 3 months, 6 months, or a year, their penalty, their deductible is going to be far more than what they save by getting that lower rate in cash back. And it's so important that we're looking at the features of the products and then recommending the appropriate product to the client and explaining the risk. You get into an accident with this monoline mortgage, your deductible is lower. You get into an accident with this bank mortgage, you're going to have a big deductible, like that 4-year, 5-year fix from Scotia that closed in the summer when bonds were much lower, has a penalty that's more than the minimum. Let's look at the chat here. So
yeah, just a couple questions.
So how or where do we locate the posted rates to be able to calculate the penalty? So The thing here with this is it comes down to knowing the rules. So if I look at a Scotiabank, they assign the discount based on the posted rate at closing. So one of the things we do in our training program is we've been tracking the posted rate history. Now you can look at old rate sheets. You can, the lender's not going to tell you what the posted rate was in the past. They just tell you what it is today. So by paying attention to what the posted rates were at closing, say with a Scotia mortgage, you can determine how, as they progress through their term, as the posted rates are being compared to change, whether their interest rate differential stays the same, increases, or decreases. And when I look at posted rates and tracking it, it's like, if we're going anywhere, we need to know where we start. And the issue here with the banks is that they make it difficult for us to know where we're started. So we don't know where our penalty is. We don't know if it's big. We don't know if it's small. And so that's where you have to have it, where you're paying attention to these things. I've asked lenders to put it on the commitment, the portal. It just comes down to it. These are things we need to be paying attention to, because with the banks, there's the rates, your payments, interest, principal portion, all that. But then there's the discount based on the posted rate, and then the current posted rates that determine how the IRD changes over the course of the term. Whereas with the monolines, it's very simple. It's what was your rate? What rate are we comparing it to? We're less concerned with the history in between, because their rates move up and down based on bonds, because they're stuck together. So things we have to pay attention to. Yes, TD annual mortgage statement. Most lenders will send a confirmation letter. Some lenders, I know BMO will have it if you are on their online banking. It'll show for your component the discount you received. It just comes down to, if you're not tracking this stuff, you have no idea, or you have to get information from the client or have them get it from their lender to figure out, is your IRD more than it should be, what it should be, or less than it should be. And if you're not paying attention to that, it might drift from one category towards risk, or it might drift to opportunity, and you don't know. And the lender's only being reactive. They only let you know what it is if you reach out, and they only let you know what your IRD is when it's greater than 3 months interest. So is it default insurance deductible? How much do we know? I don't know, maybe there's some confusion with that, Sonia, if we can clarify. I'm just explaining this more in the sense of, people are optimistic. If CIBC is offering a 3.99% 3-year fixed, they're doing it because the cost to return that mortgage, if you don't finish your term, is much higher than their competition. So I look at a CIBC 3-year fix. The minimum penalty is not 3 months interest at 3.99%. It's 3 months interest at 6.99%, which is 75% more. So the minimum deductible is 75% more than the same rate with another lender. We look at cashback, if they claw it back, even if you return it 1 day early. And then if we look at an interest rate differential, CIBC, they compare posted to posted, so higher rate to a higher rate. And then they also don't give a present day value adjustment for the future value of these differences. So if I look at this, I say to a client, if I'm competing with, say, a Scotia 4.09 or 4.19, I explain, you win by finishing the term, and here's what you save. If you return your mortgage any point earlier before maturity, the Scotia option is better. And it just comes down to, the Scotia option might be better by $1,000, $5,000, $10,000, depending on the point in time that they return the mortgage and where the posted rates are at that point. And I say, look, CIBC is not being transparent. You get to work with a broker. We're going to let you know how your deductible changes. And then I'm hoping that I can add enough value there versus the client that just wants the lowest rate, but with the $10,000 deductible, right? There are people selling insurance that sell the products with the lower deductible because the client values that. The client can't value that unless we identify it. And that's why it's so important. Are there any questions, any scenarios anyone wants to go through? Any lenders that or product selection? Really, for here, it's just talking about where we can see some value, because if we're competing based on the lowest rate, we're not going to win. Sonia?
Yes. Just back to my question. I was trying to ask, the deductibles you are talking about, those are the default insurance deductible, correct?
No. In this case here, I'm basically equating prepayment penalties to the deductible, like on a car insurance policy. Okay. So the notion here is, if you look at it, if I was going to get you the lowest car insurance, the lowest car insurance tends to have the biggest deductible, or maybe not even coverage on your car, just on everyone else, or there. So you look at, if I'm like, yeah, you want to pay $100 a month, your deductible is $10,000. You can see that. You probably don't get the $10,000 deductible. You pay a little bit more. The issue here is that we tend to equate that, oh, 3 months interest is the same, when it's not. Oh, IRDs are going to be the same. Oh, if rates are coming down, not realizing where posted rates were and how they are today, and where they're trending. So what happens is you have that, CIBC mortgage, they're offering the low rate, but they're not telling you about that potential $10,000 deductible. You have TD or Scotia, they're not really telling you about that $5,000 deductible. You have the monoline that has the higher rate, they're not telling you about that $200 or $500 deductible. And really for us, it's just breaking this down and explaining the options to the client, and explaining how they win depending on what happens, right? If someone is taking a bank 3 or 4 or 5 year fix, they win by finishing the term, okay? Different levels of winning depending on the product and your deductible, but there should be no expectation that you can jump to a lower rate mid-term if rates come down. Monolines, you might get that opportunity because their penalties tend to be what they are, and there's some situations where they're less than they should be. So just explain this to the client so they don't expect in a year, if rates are 1% lower, hey, where's your penalty? It's still in the red. Why? Because the lender's not saying that they can earn 4% or 3.5%. They're saying they can only earn 2%. Why? Because they dropped the posted rates by more than double what actual rates have dropped. And by understanding that, we can get ahead of it and make sure clients are aware before they see something that they want, that their penalty is in the red. It's not good. And so that way they're not having it, they're not upset, and we need to do a better job ahead of time to make sure they're aware of the product selection. Like I might not be pro bank 5-year fix, but I'm the safest broker you could buy a 5-year fix from. Why? Because I understand the risk, and I understand why they're able to heavily discount their rates, because they know 20, 30, 40% of mortgages aren't going to finish the term and are going to pay a deductible that's far greater than it should be. And that's what the lender's looking at, and they're hoping that people overlook that risk. So let's just see here. So yes, a scenario to calculate prepayment penalty for a mortgage renewal November 2025 current is 6.5%. So Rashna, which lender is that with? The 6.5%? Okay, RBC. So I know just by looking at trends, the penalty is 3 months interest. Okay, and the reason for that is, so the remaining term, we have 1 year remaining. The multiplier 1 year is pretty small, and I know just by looking at different trends, whether it's a mortgage, whether it was a 2-year with 1 year left, a 3-year with 1 year left, I know the penalty is 3 months interest. Now, are we at risk of the penalty going up? Probably not, because the remaining term is so low. It just comes down to, for here, if you think of that 6.5%, you're having your 3 months interest is 1.5, like 1.6%. As long as you're getting a low enough rate, it just comes down to it. The clients have to believe that rates will be similar in a year versus now to justify paying that. So I do see some value. Where you have to be cautious is the product that you're putting them in, right? Because if, let's say, the plan is for them to sell in a year, the better move might to be do nothing. Whereas if you put them in a TD Bank 3-year, Scotia 3-year, there's a good chance, although they may recoup the penalty over the year, their new penalty is most likely going to be an IRD because posted rates are going to drop. So it's very important that we're selecting the right product. Yes, there's definitely savings to be had here, but they're basically pushing up their mortgage decision versus deferring it to November 2025. Penalties 3 months interest. RBC would have to aggressively drop their 1 year posted for the IRD to rise beyond 3 months interest, but I feel like you're pretty safe there. So Kimberly asked, do you have a list of big bank lenders and how they're calculating IRD? So the thing here with this is, and we'll say most lenders, okay? National Bank does things a bit weird. CIBC does things a bit weird. B2B does things a bit weird. But when it comes to IRDs, we really have to look at it like this, okay? What rate did the lender lend you the money at? And what rate is the lender saying that they can get? So like we saw with our Scotia and TD examples, the 5-year fix, August 8th, 2024, 4%. The lender's saying they can get 3.7%. And they do that via posted rates and discounts. The 4-year, okay, the lender is saying, we lent you the money 4%, we can get, in this case, 3.6%. You owe us 0.4% per year for the remaining 3 years and 8 months. The TD Bank 5-year fix from a year ago, we lent you the money at 6%, we can get 5.7%. IRD is less than 3 months interest, but we're still charging you 3 months interest. So everything, monolines, it's easy, contract to contract, what's the rate we're being compared to? They tend to be, most likely a little bit lower penalties than they should be. But where we get into trouble are lenders like Marathon. Oh, we have rates tied to bond yields. So we lent you the money at, let's say, 4%. We're comparing you to 3.6, 3.7. We're automatically comparing you to a rate that creates a positive interest rate differential. So it just comes down to just looking at this and mapping it out. Now, different lenders have different rules in terms of which one that they compare to. But for the lenders that are doing the IRD calculation the correct way, it all just stems from what rate did they lend you the money at, and what's the comparison interest rate after we look at the current posted minus the discount that you received. We compare those rates. If the rates are the same, you have an interest rate difference of 0, you have an interest rate differential of 0, you pay 3 months interest. If the new rate is lower or higher, we have a negative interest rate difference, a negative interest rate differential. They have to tell you that they can't earn all the interest, and they have to tell you by a big enough margin to create an IRD greater than 3 months interest. So so it's not a course. We don't run a course. We look at it for here is that brokers don't understand mortgage return fees. We provide coaching, support. We show you the trends. We're launching a penalty calculator. We're launching you can track your entire database and see, is it red? Is it yellow? Is it green? How do we map things out? How do we present, where the risks are to the client? Because at the end of the day, if we can do the calculations, it makes it a lot easier for you there. And I'll be sure to put some information in here afterwards. You can go onto our website. I'll just put it here right now, penaltymentor.ca. So let's just see here, other questions, RBC, copy the recording. So question, is it more accurate time to check term penalties, anniversary dates, -1? So I look at here, and what I'm going to challenge everyone in the group here, and I promise that if you do this, you will either spot mortgages in the red that you didn't think were in the red, and mortgages in the green that you didn't think were in the green. Any lender that does posted rates and discounts, you need to get your clients to get penalty quotes today, okay? So in this case here, all the big banks, we got it, who else would we have? Like B2B, Equitable, Coast Capital, just any lender that does posted rates and discounts, you want to have it where you get them to get a penalty quote. And so from there, I think all of us have an idea of 3 months interest. You also want to get them to ask what their discount was or what the posted rate was when they got the mortgage. And then from there, we spot opportunities like TD. Like everything right now at TD, 10-year, 7-year, 6-year, 5-year, 4-year, 3-year, 2-year, 1-year, 6-month, everything is 3 months interest right now because they haven't lowered the posted rates enough. So what you want to go and do is this. You want to identify a mortgage where if they can return it and pay 3 months interest plus a reinvestment fee, that you can add value. Okay, so let's say that 6%, 5-year, 4 years left. I know you can add value. In fact, I know you can probably recoup the penalty in 1 year, save for year 2, save for year 3. Okay, now what are you up against? If TD Bank lowers their 4-year posted, the IRD is going to increase. One of the great things about TD is their payouts are valid for 30 days. So what you need to do is not be enticed by Scotia's instant funding program. You need to have it where you go and say, hey, my favorite lawyer and notary, the client's on board, can you order a payout? And then you have 30 days to figure out the exit strategy and then move them before the penalty goes up, because that payout will lock it in. And I'm certain that there are mortgages out there, whether they're in your database, in your network, or people you haven't even connected with. We're just letting them know that the TD penalties, the TD deductibles, a lot of them are in the green, I guess green, and they're in a better position than we might think that they are. Now, the flip side, the risk is the new mortgages we're getting, higher posted rates, higher discounts. We need to be cautious putting clients in bank 3-year, 4-year, 5-year, because the expectation is that the penalties are going to be in the red, bigger than they should be. So they need to be finishing the majority of the term in order to mitigate what that penalty will be, right? The remaining term is the multiplier, and the closer they are to maturity, the more likely the penalty will be 3 months interest. Question here, so when you do the penalty math for your clients, do you always have them confirm with their lender as well? So I look, if the client doesn't trust me, they can always confirm with their lender. I just tell the clients they don't have to commit to the plan until we have that payout in hand based on the number or a number that works. So let's say I have it where the TD client, I know we're up against, the penalty is going to go up. We get that payout ordered. It's valid for 30 days. Boom. I told you it's 3 months interest plus the reinvestment fee. We map out a plan and they move. If let's say I'm dealing with a Scotiabank, it's already an IRD, I might have the clients consider paying the penalty early, okay? Or the moment a posted rate changes, I'm telling them how, like, oh, they dropped this, our penalty just went up $2,000. Okay, we're going to confirm that whether they talk to the lender or now we got the payout. Yeah, it went up $2,000, but now you're saving $8,000 instead of $10,000. At the end of the day here, they don't have to commit to the path until they see a payout with a number that works, right? I'm noticing the trends. I'm trying to get the clients moving. I'm trying to get brokers to get their clients moving. But at the end of the day, yes, I mean, they can talk to their lender. Now, there's the risk that their lender is going to try to scoop them back. And I go and I frame it like this to the clients. I say, look, the lender could have picked up the phone, TD Bank could have said, hey, your penalty's on sale, want to get a new mortgage, and could have done it over the phone or done it really easily. For them, they're going to offer you whatever it takes for you to stay, but only because you figured it out, because a broker is being proactive and they're being reactive, right? And so at the end of the day, it's like, do you want to continue to work with someone who is taking advantage of you, or do you want to work with someone who's looking out for you for the long term? And that's where you can kind of get the clients off, maybe even a slightly lower rate with their existing lender, because they know they're just going to be in that perpetual cycle of reactive, not proactive. Right? So just those are things that we need to go and do and prepare. And at the end of the day, worst case, if they stay with the lender, hopefully they talk to me. And then they're still be like, I found this out because Matt or someone in the training or someone watching this presentation saw the value. And it's not about doing every deal at all costs. It's about having it where people see us as experts. So they want to interact with us. They want to talk to us about their mortgage. If you have 100 people talking to you about their mortgage, you're going to get business. You're not going to get all the business, but you're going to get business. You're going to add value. And they're going to quickly realize that they would be better off having you in their corner all the time than just take that tidbit of information and run with it on their own. Because there's so many things that can go wrong with just a little piece of information, whereas we have the full scope. So every lender has a different length of time they will honor the penalty quote, correct? Yes. So from what I can tell, I would say that it's typically 2 weeks. That tends to be like, I'd say the average amount. There's some where it's like 3 days, some 5 days. I saw it, was it Simply's 30 days, TD's 30 days. So at the end of the day, if the IRD is close, so part of it, we have to get a quote, but also, and that's where we help with our training is, where's the IRD? If the penalty is 3 months interest, they tell you it's 3 months interest, whether the IRD is right here, here, or here. If it's here, and the payout's valid for 30 days, I want to order it immediately, right? Maybe I eat half the cost of the lawyer and notary. If it's here and I have room, I might have it where, yes, Scotia instant funding, but I'm monitoring as it's going up. And if I need to pivot to getting that payout in hand, I go and do it. If it's already an IRD, let's say it's a TD, it's already an IRD, I want that payout ordered. Why? Because every subsequent drop to posted rates increases the penalty and eats into the potential savings. And especially right now with the fact that rates aren't really going down, but posted rates are and IRDs are going up, it's not like we're going to improve on the rate with the new lender between approval and closing. Most likely the rate we got at approval is going to be the rate at closing. And if we're set to save the client 10 grand and the posted rate drops, now the penalty doubles, and now it's eating into that 10 grand by 5 grand, 7 grand, 8 grand, it makes it less likely that we're actually going to go and move that mortgage. That's why we need to identify where we're at. And that's what we do with our coaching and with our tools, so that you know when to spend the money to be speedy. And you know when you have time where you can go the slower, cheaper option, but you know when you can have to pivot and where you're at. And that's the thing. There are brokers that are going to take this information, spot the opportunity, but not realize IRD's here. If it gets to here, the deal collapses. Or having it where they rush when they're here and they could have used instant funding, right? So it just comes out of knowing where you're at. And because the lenders won't tell you where the IRD is unless it's greater than 3 months interest, you're at a disadvantage unless you know, based on the calculations, what the IRD is, even when it's less than 3 months interest. So that's good for questions. Are any other questions? Any other scenarios? Like I could talk about this forever. So it's not, I'm not tired. I just hope the lenders don't cut my head off, you know? Any questions, Sarah? Let's do some banter here. Come on.
I'm good. I think that oh, here we have a question. Are banks still at 3 month interest rate?
So the thing here is, so TD Bank, yes. Everything at TD, 3 months interest right now, right? And so I know that by going through scenarios, and I can't find a mortgage where the IRD is greater than 3 months interest. For all the other banks, there are select 5-year that have IRD. It just, if they were at like a peak posted rate and they come down a bunch, RBC's cut their posted rates either like 8 or 10 times. So every lender has 5-year fixed, other than TD, has 5-year fixed where there's IRD greater than 3 months interest. CIBC, I can't spot if it's 4 years or less, like originating term. I see them all as 3 months interest at the initial posted rate. Let's see, Scotia, BMO, I don't see any 3 years that have IRDs, but there are definitely 4 years and 5 years that do. And that's where we're getting close. And that's why it's so important to get that penalty quote. Oh, I thought it was an IRD, but it's 3 months interest. Oh, what's the discount? Oh, it just turned out that they closed at a lower discount. So they're here. Oh my gosh, yeah, I can save the money. Okay, yeah, do we rush? Can we get the payout ordered? Oh, can we, do they pay the penalty, go into an open? And we just want to really like dollarize. And that's the thing here. So when we looked at our Scotia examples, we lent you the money at 4%, we can get 3.7%. Whenever the comparison rate triggers an IRD, that is our target savings rate. So if I have that 4%, 5-year fixed from Scotia with 4 years, 8 months left, and they're charging me an IRD based on 3.7%, I have to get a new 4-year, 8-month term at a rate lower than 3.7%, which I'm pretty sure nobody can get. So that is why the penalty is more than it should be. That 4-year fix, 4%, they're telling us they can earn 3.6%. It's a big enough interest rate difference times the 3 years, 8 months. The IRD is greater than 3 months interest. In this case here, I need to get a new 3-year, 8-month at 3.6% or lower. The penalty is bigger than it should be. And those are just unfortunate because they closed at a low rate with so much potential energy when it comes to these posted rates dropping, that they closed the day before a cut. And then the next month there was another cut that triggered an interest rate differential greater than 3 months interest. And the bank isn't telling them unless they call in and they say, oh, your penalty's this. And then the client doesn't realize how that's going to change over the course of the term. Now, where you could add value to that client is that the client said, we're selling in 3 months. It might make sense to pay the penalty now, you know, lump sum first, whatever, sit in an open and then sell, versus waiting and having those posted rates drop further and the IRD going up. And so that's why just letting people know where they're at. From there, we can determine, is there something we can do based on our current plan to save the money? Is there something if there's some sort of pivot, or if there's something where there's a major pivot and we're mitigating our penalty by doing something today? So let's just see here. Does the calculator take into consideration letters like CIBC that charge the full amount on cashback received at time of contract? So yeah, that's something we can definitely put in there. I look at for this, if you're dealing with lenders that are going to claw back, it's always good to get a quote, or even too, like there's clients that don't realize that they got cash back. It's always good to confirm, right? Because you'd hate to have it where even if they're clawing the cash back annually, like most lenders do, oh, we don't have the $10,000 to pay this back. It's an insured mortgage, collateral transfer, and it turns out that derails the deal. So I find for here, it's that you would have to tell us if there's cash back and the type of cashback. And then we would apply the lender's rules. So CIBC, they claw it back, even if you return it 1 day early, which means if they have cash back and a penalty that's bigger than it should be, you're probably not moving the mortgage. You're more likely moving them at maturity. If it's, and just kind of knowing where you're at, because at the end of the day, you don't want to find out at the last moment and have it where you did all that work for nothing. And you could do all that work for nothing and the client paid for an appraisal. Now they're asking you to reimburse them. So you did all that work, the deal didn't fund, it impacted your funding ratios. And now the client's expecting you to give them $400 for an appraisal for a mortgage that didn't fund. That's why understanding the return policies, the penalties, and where you're at and how things can change allows you to do smarter business, be more efficient, and only start something if the client's going to agree to a payout being ordered. Consider paying the penalty sitting in open, identifying the moment the penalty's increased and proactively telling the client. And then for there, if they don't see value in continuing, you stop working on the file right there and cancel it, versus getting the payout, having the penalty go up. And then now, are you throwing most of your commission at the deal to make it work? Or are you having it where you're in control as much as you can in order to maximize the value and be an expert for your clients? Okay, do monolines typically have more favorable? So I wouldn't use the term favorable, okay? Because right now they're not favorable. TD Bank, 3 months interest, any monoline 5-year fix from last year, IRD. But the IRD is in the yellow. It's what it should be. Why? Because they lent you the money at 6%. Their 4-year rate, let's say it's 5%. You owe them 1% per year for 4 years. You're paying an IRD of roughly 4% of balance. They're more consistent, okay? The levers here, they have to move their actual rates and their IRDs. They have to move them in sync. They're stuck together, they're attached. Whereas a TD, because bonds have dropped, TD can go and lower their rates by 1.5% while lowering their posted rates by 0.3. So in that case, the IRDs are 1/5 of what they should be. But what's going to happen here for new mortgages is they're going to be heavy on the IRD lever. They're going to drop that 1.5%, actual rate stop 0.3. Now that new mortgage has an IRD that's 5 times what it should be. And if you're selling these products and not explaining the risk of the deductibles, you can't just go and say, oh, Scotia would have just been the same. Well, Scotia's actually better than TD because of some of the things that they do. So it just comes down to explaining, like, yes, that low rate, yes, that cash back. Why? Because they have so many moves on that IRD lever, the potential that they're just waiting on. You want these mortgages to close. They want rates that's going to stay where they're at, maybe even go up a bit. And then now they lower it and they tell a different story. Oh, we lent you the money at 4%. We can get 3.5, 3.2, 3% to create a big interest rate difference, big interest rate differential. Those who finish the term win. Those who return the mortgage subsidize the interest rates for those who don't. And maybe if that client was more likely to return the mortgage, what do they go and do? They go with a variable. They go with a monoline mortgage. They go with a HELOC. Like, they go with a lender that calculates that, has to, that the IRD is trending in the right direction. And that's the thing here. It's why we're seeing this big gap, because the deductibles or future potential deductibles are so much greater with the banks than they are with the monolines. So we just have to be careful using the term favorable, because I'm sure anyone who got a monoline mortgage from a year ago doesn't feel like they're favorable. It's lucky that TD, everything's 3 months interest. We also have to look at the banks. They have multiple personalities. They can be really good, but for them to be good for existing, they have to be really bad for new, because they're getting bigger discounts, bigger penalty risk.
Matt, do you think we could do one more scenario maybe, but like,
sure, yeah,
go through it like super slow,
yeah,
even like similar to the ones that you did in the beginning?
Yeah, what scenario? Do you got one?
I don't. Maybe even repeat the ones in the beginning for those who might have felt it was a little bit fast.
Okay, so here's a question. If you're looking at your database, would you be seeking TD clients placed in the last few years if their rates were higher than today? So the thing here is, my focus would, like, the highest rates, the longest remaining term are the most value, but the IRDs are getting close. The issue, if you go further in the past, is one, you have less remaining term to recoup the penalty. So you probably have to extend the term. Extending the term adds risk. But you also have it where some of these mortgages, the IRDs, they're less than 3 months interest, but they're zero or they're negative. So if the rate's high enough, you might be leaning towards like a TD replacement where the entire penalty minus the reinvestment fee is reimbursed. I would just be very cautious, because if, let's say, you had a client with a 5-year fixed at 6.24%, 5-year posted, and now you're getting them a new 3-year via replacement, you're increasing their posted rate from 6.24 to 6.94. And in that case there, you're actually increasing the IRD risk, even if your new term is similar to your current remaining term, right? That's where you just have to be really careful. That's where if the rates were close enough, the client might be able to pivot to a variable rate. But a lot of those like older TD mortgages, even with high rates, and even with Scotia too, high rates but low deductibles, there's a good chance that they'll finish the entire remaining term and their IRD will stay below 3 months interest. So it's just very important that we're not just chasing the lowest rate, that we're also identifying the additional risk when it comes to deductibles. And if we're not capturing that properly, we could move a client to a product, save them some money over a year, but put them in a position, if they have to return that mortgage, that the cost is far greater than it would have been if they'd stayed in their current mortgage. And so that's where, with the tools and stuff we're working on, is just kind of helping to map this stuff out, because there's a lot that can change, and there's a lot that the lenders are having us overlook, because they want us to focus on that low rate, the cash back. They want us to focus on those features, and they don't really talk about the deductibles. So we can go through a scenario. Let's just see here. Let's think what scenario we should go through.
Matthew, can I give you scenario?
Sure. Yeah, you have a scenario? Awesome. Let's do it.
Okay, so the term start date is July 1st, 2023.
Okay.
And maturity date is July 1st, 2027.
Okay.
And term is 48 months, right?
Okay, 48 months. Which lender?
TD.
Okay.
Fixed interest rate is 5.44.
Okay.
And amortization is 30. Remaining time is 20 years, 6 months.
Okay, so in this case, you're July. So we'll base this on December, August, September, October, November, December. So we have three years. Oh, sorry, 2 years.
We have to look at
2 years. August, September, November, December, January. 2 years, 7 months. Okay. And so we'll look at this, and this closed, you said July 1st. Now, most likely there was an interest adjustment, because July 1st, Canada Day, we weren't getting mortgages that day. So most likely it closed. And that's why we have to pay attention. If it closed like June 2nd, it's not really a 48-month term. It's really like 48 months plus 29 days, right? So that's why it's so important, the maturity date. So what we'll do here is I'll share my screen, and we'll go through like our dashboard and everything. Share a portion of screen. Let's just see here. That's here. We'll go over to TD. So we've been tracking the historical posted rates here. So if we look at this, so July 1st, 2023, 4-year, what we can see here. So TD Bank sets the discount based on when the rate was set. In this case here, we're just going to say that it was set based on 6.09. Okay.
Yes.
We know, and we can look at our chart. If I look at my IRD references here, TD comparison charts, we know in this case here, 2 years, 7 months is 31 months. In this case, we know we're still being compared to the 3-year. Okay. So it's very important we know to have this chart for every single lender. And so now we go back over to TD. So we're being compared to the 3-year. And so this is where it's very, actually, no, so this one here, so that's 4-year. Okay, so we have 6.29. Okay. And in this case here, now we're being compared to the 3-year. Okay, so looking at that, if we pull up our calculator over here, 6.94 minus 6.29. And so the easy way to look at this is, and this mortgage has a little bit of a superpower to it. I would tell the client, say, look, your penalty is 3 months interest. In fact, your IRD is negative. They would have to lower their 3-year posted by 0.65% just for your IRD to be 0. And then from there, they'd have to drop it. You know, we can do the quick calculation, okay? In this case here, what did you say the rate was? 5.44. So I take 5.44 and I always want to convert it to a percentage of balance. So I take that, I divide it by 12 months, I multiply it by 3. So 3 months interest is 1.36%. I only pay the IRD if it's greater than 1.36%. I have 2 years, 7 months remaining. So 7 months divided by 12.58. So I have 2.5833 years, okay? So I'll take my 1.36 divided by 2.583333. So in this case here, and we'll just round that to 0.53%, okay? So in this case here, for TD to cause the IRD to rise beyond 3 months interest, one, they'd have to drop their 3-year posted by 0.65% just to get to 0. Then from there, they have to drop another 0.53% for the IRD to get to 3 months interest. Now, that's the quick calculation. It doesn't factor in amortization, present value, or compounding. We actually have a little bit more room, maybe like 0.1% of room, right? So we'll just add in that 0.1%. But effectively here, what we're saying is, and we could take this 1.28%, so 6.94 minus 1.28%. And this is stuff we're going to have with our calculators and our tracker to go and say, hey, client, I'm just letting you know your penalty with TD will remain 3 months interest unless TD Bank drops their 3-year posted from 6.94% to 5.66%. And that's where for here, when we're looking at our trends, we can see, well, when, you know, what was that like? That was back, you know, we have to go back to September of 2022. Now, the crazy thing is bonds are actually lower now than in September 2022. So sure, this can happen. But I think what will happen is the IRD will stay below 3 months interest and it'll just kind of progress. And then eventually it's compared to the 2-year. This mortgage here, the probability of having an IRD is so low. So that's why if we're going to something new, let's say we go to a new TD Bank 3-year, right? We're working off of this and we're actually increasing our penalty risk for 2 reasons. One, we're going from 2 years, 7 months to 3 years. So we're adding 5 months. And we're also increasing our posted rate that we're working a discount off of by 0.65%, right? So yes, we could do TD replacement mortgage, get a new 3-year, but the client needs to be aware that there's a lot of risk with that. And it could end up being worse than doing nothing. Let's check the chat here. So is there a calculator software that can assist us with the calculation of the penalty for each lender? So that's what we're working on. In fact, we started to onboard a lot of brokers in our training. We have a wait list, but if you want to get access to it, you know, I guess before everyone else on the wait list, we focus on coaching because we can see the trends here. I don't need, other than a standard calculator here, I don't need much to determine where the IRDs are at, spot the trends, and then from there have a path to save the client money and knowing what can go wrong or where we need to rush or where we can slow down. So I put in there the information about that, and anyone, okay, I'll just type this in. So here's another scenario. I'll stop my share. 5-year fixed renewal, July of 20 renewal. Okay, so it renewed. I'm confused. Renewal July 2026. Okay, can you share the formula? So the thing, different lenders have different. Which formulas are you referring to, Sarah?
The math that you just took us through, like, can you? I was trying to jot down the formula as you're going.
Yeah, okay. So okay, we'll go through here. So what
Just guys,
I do,
we have about 3 minutes left. I'm sorry, we have
okay,
to...
we'll do it quickly. We'll do it quickly. And worst case, message me afterwards. Okay, so what I do is I always want to express the penalty as the minimum penalty as a percentage of balance. Okay, so you take your rate and you divide it by 12 and multiply it by 3. It's basically because 3 months interest is a quarter of the year. Okay, and then in that case there, I take whatever the percentage is, and then I convert the remaining term into years. So if I have 2.5 years, that's 2.5. I take my 3-month interest as a percentage of balance, and then I divide it by the remaining term. And what that does is it gives me basically the threshold that I can handle for an interest rate difference. So let's say that threshold ends up being 0.5%. Oh, my rate is 5%. The lender has to tell me that they can earn less than 4.5% for my IRD to be beyond 3 months interest. Okay, it just gives me like a quick frame of reference. So if I look at, say, like a monoline and I'm like, oh, my rate's 5%, they're saying 4.75. I have 0.5% of room. I'm only using half of it. They would have to lower that comparison rate by more than 0.25% before it changes my penalty. Okay. That's where then you can get more into the weeds with the calculations in terms of amortization, present value, compounding, how it changes as you progress through the term, how much room that you have. But the idea is that if the quick calculation doesn't generate an IRD, then the actual calculation won't. And just depending on, like if a mortgage is a really low amortization, it takes more to trigger an interest rate differential greater than 3 months interest because the lender's expecting to earn less interest over the course of the term via the lower amortization. Higher amortization, it takes less to trigger a penalty greater than 3 months interest because the lender's expecting to earn more interest via a 30-year amortization versus a 5. So that's where then you have to dive deeper to see how it impacts things there. But I'll see something else. Let's see. But yeah, I mean, you know, I'm sure most of you know how to find me. You have my website there. You can send me an email if you want to learn more. We're gonna have a preview of the penalty calculator and things to come. It just comes down to here. It's by understanding this stuff, we can go and look, is that monoline, the penalty risk is so much lower. It has that low deductible, higher premium, or that bank mortgage, whether it's one of our banks or our competition CIBC, is that rate lower, less premiums, but the deductible is going to be higher. And you look at it like whether a client buys the lowest deductible and doesn't crash their car, or gets the highest deductible and like people just want to know what it is that they have. And it's really our job to define the products, advise them, make sure it suits their needs, let them know the risk of it, whether they deviate from what they should be buying, and then update them to as how things change so that before they think of doing something, they already know is their penalty more than it should be, what it should be, or less than it should be.
All right, that's so awesome, Matt. Thank you so much. I mean, this is like a spiral. We could go down to like for hours and hours and hours. So that's why Matt has made such a project of this, and he really is the best to describe this and simplify it. So this is just barely scratching the surface. Reach out if you have more questions. We really, really, really appreciate your time. Thank you so much for coming on and, selfishly explaining all this to us. Some of us might still be a little confused because it is a lot of information, but that's okay. This is just maybe a first conversation about it. There's lots of tools and resources that we can seek out on this, and it really does, at the end of the day, help assist our clients. So thank you so much, Matt.
Awesome. Thank you so much for having me, Sarah. And if you need any help, like I'll try to help you as much as I can. Like I said, we're developing stuff, training, nobody else is doing it. This really helps you to be experts and it'll help you to grow your business, and also make sure you're not going to get yourself in trouble with suitability and recommending the wrong product. So reach out if you need some help. We have some resources we can share. Happy to help turn all of you into prepayment penalty experts.
Awesome. All right. Bye, everybody.
Bye.
Thanks so much.